that the silver price could double. I was wrong. It quadrupled.
Yeah.
That's stupid. That's paying me my own money back. I need the company to grow before they pay me the surplus. Capital, if they take from growth, is not surplus capital. Causes good commentators to call it the CP lie.
Yeah.
My suspicion is that the deterioration in the purchasing power of our currency, which is what I characterize as inflation, I think that number is closer to 8 or 10. The idea that you will ever actually catch them physically short so that they get bought in for cash will never occur. 80% of the time I ask that question, the management team can't answer it, which is to say they don't have a plan. Now think about that. How are you going to get somewhere without a plan? If you make mistakes in a market like this, it's tragic. There will be a lot of people who conspire to lose money in this market.
Welcome back to Kitco News on location here at PDAC 2026 in Toronto. I'm Jeremy Safran. Now, we are witnessing a historic reconfiguration of the global markets. Over the weekend, U.S. and Israeli strikes on Iran resulted in the death of the supreme leader, triggering a haven-first rush that has sent gold to 1 month high of about $5,400. Now, simultaneously, we're seeing a black swan in the physical market. The UAE has partially closed its airspace, effectively paralyzing the Dubai gold hub, a critical artery for shipments to China and to India. And in the middle of this, a violent divergence. Gold is holding firm at about $5,300, but silver is being flushed down about 5% this morning. And joining me is a man who has been a loudspeaker for this resource supercycle, a good friend of our show, of course, Rick Rule. Rick, thanks again for joining us.
Thank you.
Don't need an introduction to our audience, Rick. Everyone knows you, and they know you because they trust you. And I'm curious about what that trust looks like right now in this multipolar world where we have gold sitting at 5,400, silver down about 5% today. I mean, you were recently a seller of physical silver to redeploy into equities. Did you see the liquidity flush happening? I mean, did you have a bet here?
Something much simpler than that.
Yeah.
I bought silver some years ago because it was hated. And I believed that when the hate dissipated, that the silver price could double. I was wrong. It quadrupled.
Yeah.
But I'm an old guy, and I'm a disciplined speculator. When a position performs the way I had hoped, I sell it. I looked at my silver position and said, as a speculation, it's run its course. So benchmark it against some other speculations and see if it stays in the portfolio. What I discovered was that the silver stocks themselves were being valued by Bay Street at about $45 silver. Therefore, if the silver price held constant at 75, by definition, I wouldn't make any more money on silver, but I could still make money in the silver stocks. Conversely, if the price fell, because of the implicit discount in the silver stocks, while their prices might fall, their values wouldn't. So about 50% of the money I made by selling silver, I put into the silver stocks. But remember, for me, it was a speculative position. What really happened is that silver ceased to be hated. I got the price appreciation I wanted.
Rule's silver trade is the single most important credibility moment in this interview. He is not a perma bull talking his book. He bought at maximum hatred, set a specific target, a double, was wrong by getting more than he expected, and sold it using a systematic benchmark process rather than greed or emotion. The redeployment math into silver stocks is textbook value arbitrage. Bay Street was pricing miners as if silver were $45 when spot was $75. That $30 gap had to close either by stocks rising, silver falling, or both. And the implicit discount in the stocks provided cushion on the downside, even in the bear case. This is not a tip. It is the framework for how a 50-year professional thinks about the commodity equity versus commodity price relationship at any moment in a bull cycle.
Yeah.
Sold it, moved on.
And I feel like, the audience needs to know this. I mean, they sometimes forget that the fundamentals are, buy low, sell high.
Correct.
And you redeployed it into the miners. So talk to me a little bit about this attitude on the ground today. I mean, there's a lot of people at PDAC this year, a lot of people excited about these prices. Good deals out there?
I don't know if there are good deals. There are people doing good work. I'm starting to see the exploration expenditures that came into the system 12 years ago, 13 years ago, starting to bear fruit. And one of the things I've learned being 73 years of age is when the industry, as an example, moves into a new area or a new method of exploration, it takes a decade for it to work. So we're now seeing the fruits of exploration expenditures that occurred pre-2010.
And that's a runway. I mean, this should last, hypothetically, on that math.
Yes, I actually believe that. And there is now sufficient capital to follow up on good drill holes, on good work. We're coming into a very, very, very exciting period throughout the value chain in mining. But I think 2 years from now, we're coming into a particularly exciting period in the exploration side because there's been such a dearth of discoveries leading up to now. There's good results coming now. And when a good deposit gets found, it will be bought for eye-popping multiples.
Yeah, interesting. Let's talk a little bit about that. Obviously, we had some acquisition news today on the copper side. You know, there's been some talk about whether or not the juniors, you and I were talking off camera. We had Eric Sprott on Friday. Eric just basically said, listen, the majors are screwing up here. They're going to be buying these juniors right now at a discount, but in 3, 4, 5, 6 months from now, maybe overvalued. What are your thoughts?
I think Eric's probably right. 2 years ago, I would have disagreed. Yeah. I still remember the inefficient capital allocations by the seniors in the period 2000 to 2010. That was a period where the gold price was up sixfold and the free cash flow per share of the senior indexes fell. That took real courage. Yeah. I think now probably the investment community has asked the senior managers to be too cautious with money, and they're going to come into a period 2 years from now where they are asked to at least grow or maintain production. The people like Agnico Eagle that are ahead of the pack will continue ahead of the pack, and the people who aren't will, as Eric points out, be scrambling to catch up. And, you know, part of that's our fault. When I say our fault, I mean the investors. We asked the mining companies in that bad decade to grow at all costs. They did, and the cost turned out to be too high. We've probably asked them to be too cautious now.
Yeah. So maybe they're just being a little bit too disciplined at the time being. And I mean, you know, is the high alpha for our viewers in the takeover targets rather than the dividend players now?
I think that depends on which of your audience you're talking to. I know you want a one-size-fits-all answer, but I don't have one. Yeah. For the people who want to make large amounts of money but take risk, the game is in exploration. Anybody who's lucky enough to make a real discovery is going to be surprised at the takeout price. Witness Great Bear. You know, if you make a real discovery, even in a bad market, you're going to make money. But in this market, you're going to make a lot of money. If people don't have the appetite for that kind of risk, the single asset producers are viewed as riskier than the multi-asset producers. You eliminate the discount with a takeover. You eliminate it right now. Single asset producer becomes a multi-asset producer. That's probably the low-hanging fruit out there. You won't make as much money there as you will in exploration, but you'll make it quicker and you'll make it in more certain fashion. I think the valuation disparities that you're seeing in the royalty and streaming space between the great big ones and the little ones probably disappears. If it doesn't disappear in the market because of arbitrageurs like me, it disappears because the big guys take over the little guys, and that's how it goes away. M&A is going to be a big, big theme in the next 5 years. People say it's heated up, but it has nowhere near run its course.
Yeah, that's interesting on the royalty side. I mean, we just had Brandy, Smallwood with Wheaton Precious. Obviously, they've had an incredible run up. Some would say that stock is still a little expensive. You know, for the larger, or for the smaller royalties, still good value in some of them.
I bought Wheaton Precious as recently as 5 weeks ago. Yeah. The knock on Wheaton Precious, and I'd say this if Randy were, well, I guess it's okay if I compliment him if it's right here, but the street is acting as though the big transactions in royalty and streaming are behind us. Right. Randy proved last week that the big transactions are ahead of us. Yeah. They will, when I say they, I mean the big royalty and streaming companies, will do more by way of transactions in the next 7 years than they have in the last 40.
Rule's exploration expenditure cycle argument is the structural foundation for anyone investing in junior mining now. The lag between exploration capital deployment and results is reliably a decade. That means the pipeline funded in 2010-2013 is arriving right now, in 2025-2026, and it is arriving into a market with $5,400 gold and actual institutional follow-on capital to fund the drill out. The Great Bear reference is key. Kinross paid approximately $1.8 billion for a junior discovery in 2022. A bear market. In this market, with majors capital constrained and starving for replacement reserves, the same discovery gets bought for more. The M&A cadence observation is equally important. Rule bought Wheaton Precious personally 5 weeks before this interview and says the royalty streaming sector will transact more in 7 years than in its entire 40-year history. When a 73-year-old who has been in the industry for half a century and is actively writing personal checks says nowhere near run its course, that is the closest thing to a table-pounding buy signal you will ever get from a man this disciplined.
The big transactions are ahead, not behind in that space.
It's interesting. If the seniors kind of stay chill and just return capital to shareholders, what happens to the junior sector? I mean, it might come popping here.
What will happen then is that you'll have horizontal amalgamation. The capital markets reward bigger, more liquid entities. If you put two and two together, in fact, you don't get 4. You get 4.7. If you have a larger market capitalization, you get more trading volume, you get index passive buying, your share price up, you have a lower cost of capital. If the seniors don't take advantage of that, there will be lateral amalgamations. You'll see more equinoxes. You'll see more of those serial acquirers. Irrespective of what happens, the successful efforts are going to consolidate. That's what's going to happen.
That's actually a good point. I mean, when you were talking a little bit, we were talking just before about who's here. I mean, are you seeing more opportunities? Are you seeing better opportunities? You actually said you're seeing a little bit of better opportunities. So as the seniors may have learned to be a little bit more conservative from the last cycle, it feels like the juniors maybe learned to be more quality this cycle.
I think what's happened over the course of my life, granted I'm an old guy, what's happened over the course of my life is that although the funding for the juniors has been episodic, there's been a lot more money in the space. And that means that better people have been attracted to it. When I look at the median quality of promoter and the median quality of earth scientists in the juniors 40 years ago as opposed to today, no comparison. 10% of the juniors are extraordinarily high quality. Now, that does leave the other 90%, which are problematic. But if you do the work to separate the wheat from the chaff, the teams that populate the best 10% of juniors are incomparably better than they were before. Incomparably better.
There was the talk of Pierre Lassonde ran it. I think Frank Juicer ran it. There was a little bit of talk about wanting to make sure that the pension funds started to invest, the institutions getting that. Have you seen any proof of institutions coming to the market yet?
Yeah.
They're here.
There's a lot of institutional company. When I go to write a check, as a living, breathing human being, albeit a fairly rich one, what I find is, as an example, issuers are loath to give up warrants because the institutions don't ask for warrants. So, yeah, there's absolutely institutional money. Now, I happen to think that what Frank is asking for and Pierre is asking for is a mistake. I don't want the government to invest in juniors. I don't want them to allocate pensioners' funds in businesses that they don't understand. I understand it's good for the businesses, but it's not good for the taxpayer. So in that particular regard, I understand that from Frank's point of view and Pierre's point of view, an industry-centric point of view, that's a good thing. From a taxpayer's point of view, I mean, listen, the industry loves dumb money, and there's no money as dumb as government.
And they've been coming in. I mean, Project Vault. What are your thoughts on this whole, taxpayer-funded incentives in our side of the sector?
I think it's idiotic. The idea that my president will invest in mining for me, pass, thank you. I'm perfectly capable of investing my own money.
And when you look at this side of national resourcism, are jurisdictions, are they more risky that way? I mean, are you looking at jurisdictional risk differently?
You know, every jurisdiction's risky, I think. I don't think there is such a thing as a good jurisdiction. I care more about deposits. I've made a lot of money in jurisdictions like Congo and South Sudan. Took risks to be sure, but I'd rather have a high-quality deposit in what is perceived to be a low-quality country than a deposit that's not worth stealing in a country where they wouldn't steal it from me. I've done much better focusing on deposit quality than I have ostensibly with regards to political risk. And I need to say that the jurisdictions that are regarded as good aren't.
This is the single most quotable non-consensus view in the interview, and it is backed by 50 years of actual track record. The mining industry's safe jurisdiction obsession drives investors to overpay for mediocre deposits in Canada, Australia, and Nevada, while ignoring spectacular deposits at deep discounts in difficult countries. Rules framework: deposit quality first, jurisdiction second, is counterintuitive but mathematically sound. A $10 billion deposit in a difficult country at a 50% political risk discount is worth $5 billion risk adjusted. A $500 million deposit in Nevada at full value is worth $500 million. The closing line, "They're just less bad," is the kind of aphorism that gets clipped and shared. Make it a full-screen graphic with white text on black.
They're just less bad.
Interesting. Let's pivot to the loudspeaker call. I mean, I saw you on BNN. You were talking about this oil trade, right? When people weren't talking about it. I mean, fast forward to today, WTI surged about 6.5% this morning, thanks to that traffic being halted. You were screaming about that sustained capex cliff for almost a year here. I mean, where are we in that cycle on oil and gas?
Oil and gas are less hated, and I'm forgetting about the Straits of Hormuz today, forgetting about the adventure in Iran. When oil was at, WTI was at 52, 55, it was a pretty good trade. The industry was underinvesting in sustaining capital between $1 billion and $2 billion a day, and it looked to me like the oil price would firm, particularly in the out years. I remember the last time I talked to you, I was sort of banging the drum on Exxon.
Yeah.
Not exactly a spec pick.
Yeah.
Exxon was a thing of beauty at 100. It's less beautiful at 165. Yeah. It's just a function of price. So, I think the oil trade will be back. I pray that the circumstance in Iran will resolve itself in some fashion. The Straits of Hormuz will reopen. The oil trade will be back in place. Hopefully the crude price falls. Hopefully the price of oil and gas stocks fall. Because I was investing money in 2025 with the view to harvesting in 2028 or 2029, which is still my point of view. Given that I'm still trying to build my position, I would prefer that these stocks were cheaper, not more expensive.
Yeah, makes sense. And I mean, on Suncor, CNRL, Suncor is projecting $3.3 billion in buybacks for this year alone. I mean, in a world of 4% inflation and now war, is a 7% dividend yield from a North American oil producer the only safe haven bid?
Well, I think it depends on the source of the dividend. If the company is dividending that which is truly free cash, then yes. What's happening through the length and breadth of the oil business is that they're cannibalizing themselves. They're distributing an unsustainably high amount of capital back to shareholders, and they're cannibalizing their business by deferring sustaining capital investments. In that regard, I would prefer they didn't do it. If you have a company, again, like Exxon, which is distributing after buying Pioneer for $60 billion, distributing after new project investment in Guyana, and distributing after sustaining capital, I'm okay with that. The market is rewarding companies that are distributing core capital to shareholders, high dividends, high buybacks, at the expense of sustaining capital investment. That's stupid. That's paying me my own money back. I need the company to grow before they pay me the surplus. Capital that they take from growth is not surplus capital.
And I mean, even on the macro front, I mean, the 10-year is slumping. Obviously, manufacturing inputs are soaring at their fastest pace since 2022. I mean,
this is the most important warning for income investors currently piling into oil stocks because of 7% dividend yields. Rule draws a precise distinction. A dividend paid from genuinely surplus free cash after growth investment is real income. A dividend paid by deferring the capital needed to maintain production is not income. It is a slow liquidation of the business. Every barrel that comes out of the ground depletes the reserve that produces the next barrel. When a company uses that cash flow for buybacks instead of replacing reserves, it is distributing its own asset base to shareholders. Rule explicitly approves of Exxon because Exxon first acquired Pioneer for $60 billion to replace reserves, then invested in new production in Ghana, then funded sustaining capital, and only then paid distributions. That is the correct order of operations. The rest of the industry has inverted that sequence and is paying high dividends while the underlying production capacity quietly erodes.
Is the market now pricing out rate cuts because of this insurgence of inflation?
Yes, which is, I think, an enormous mistake. First of all, I think the conventional measures of inflation are lies. If your listeners will do the simple thought experiment and look at the basket of goods and services that they consume and take it back to 2020 and ask themselves, whether housing prices or rents in Canada have been increasing at 2.5% compounded or some higher number, or their gasoline, or their tax bills, or their groceries. The idea that inflation is correctly measured by the CPI, which is to say 2.5, 2.6%, causes good commentators to call it the CP lie.
Yeah.
My suspicion is that the deterioration in the purchasing power of our currency, which is what I characterize as inflation, I think that number is closer to 8 or 10. I think it's a much bigger number than people give it credit for being. I would challenge your viewers to put themselves to the test. Look at the basket of goods and services that they acquire, and look at what those price levels were in 2020, and look at what the price levels are today, and ask themselves whether the number that you're being quoted by your government is accurate or fallacious.
I mean, the government doesn't want people to know that.
Of course not.
They've been actively trying to kind of juice this up. I mean, what does that look like? We got the midterms coming up. We got the Kevin Warsh. I mean, there's a lot of things coming to fruition this year, not to mention war.
Sadly, I think most people don't want to confront bad news. If they do, they'd be forced to act on it. And most people would prefer that their problems were solved by others. And people still, unfortunately, on both sides of the 49th, believe that the government is the right place to solve the problems. I think the government causes the problems. I would prefer that your listeners, rather than wait for Carney or Trump to solve their problems, think about solving them themselves. But they need to confront them first. If you believe that inflation is at 2.5 and you get paid 4.2 or 4.3 at a U.S. 10-year Treasury, you're fairly sanguine. If rather than that, you think that you're getting paid 4.2 in a currency that's depreciating at 8% compounded, you think, I have to do something about this. Sadly, too many people don't want to take control of their financial future.
Rule's inflation argument is the most important segment for any mainstream viewer sitting in a 60-40 portfolio. The CPI has been so thoroughly processed through hedonics, substitution effects, geometric weighting, and shelter lag that it now measures something almost unrecognizable as the lived experience of prices. Rule's challenge to simply check your own spending since 2020 is unanswerable. Housing in Canada is up 40 to 50% from 2020 levels in most major cities. Groceries in the US are up 30 to 40%. These are not 2.5% per year. The 4.2% versus 8% math is the portfolio killer. A 10-year Treasury paying 4.2% in a currency losing 8% per year of purchasing power produces a guaranteed real return of negative 3.8% annually, compounded. Over 10 years, a bond investor has consumed approximately 1/3 of their real wealth while believing they were being prudent. This is not speculation, it is arithmetic, and it is the foundational argument for why gold has been rising for a decade.
Yeah. How quick should Canada move here? I mean, there seems to be a lot of bureaucracy. We're sitting in Toronto. I mean, we're talking about trying to compete with the U.S. We're far behind. I mean, at what point is Canada open for business?
That's a question I suspect that you need to ask your prime minister. My preference, would have been 10 or 15 years ago. When I emigrated to Canada from the United States in 1970, this country had a lot of common sense. You didn't go to war in Vietnam, as an example, which was a huge benefit to me. But there was, at that point in time, a very, very investment-centric tax code as opposed to a consumption-centric tax code. That's all changed. What pace of change would be appropriate for Canada needs to be decided not by an American, but rather by a Canadian.
Performative politics, perhaps?
Well, I would just ask Canadian taxpayers to think about the well-being of their children. I would ask American taxpayers the same. We, in the United States, we have a ridiculous tax code. Did you know that if you and I went to build like a mill, a tilt-up concrete building in China, we would depreciate the capital cost in year one. In other words, we would expense it. In Canada and the United States, it would be straight-line depreciation at 3%, so 33 years. And in communist China, we would expense that. Now, where do you think people are going to build? Think this through.
Did you pay attention to this silver squeeze narrative that was going on? I mean, COMEX, the banks, the halt, everything else. Any thoughts on this?
Well, I guess I'm too close to the silver market. The first silver squeeze, I was still at Sprott. And the Sprott Physical Silver Trust was adding assets like crazy. We had to go buy silver. We had some hairy moments. not because of the market, but because our own buying was so heavy. But there was never a squeeze in wholesale silver product. The circumstance that we have today is, in terms of good delivery retail product, 1 ounce product, even up to 1 kilo product, it's short.
Yeah.
There is no shortage of institutional product. There's no shortage of good delivery for people like the Sprott Physical Trust. There is a shortage of good delivery on deposit of COMEX. If we can get through the next 3 or 4 months, that solves itself.
Yeah.
The dealers are reluctantly buying back non-good delivery silver, shipping it to the refineries, and it reappears as good delivery. In the interim, the circumstance that we have is that the outstanding paper contracts greatly outweigh the amount of silver available for good delivery. Now, the silver squeeze people need to understand the way the exchanges work. The exchanges are owned by the members. The idea that you will ever actually catch them physically short so that they get bought in for cash will never occur. The exchange will declare force majeure. They'll cash settle. They'll halt the contract. They'll cash settle, wipe their hands and go away. The idea that you're going to catch JP Morgan Chase or Conti or any of these guys physically short is nil. It's a non-starter. It will never happen. If you look back to the tin trade, the nickel trade, when the dealers get too far offside, what's going to cost them on their balance sheet? Force majeure, suspend the contract, cash settle, drive on.
This is the most viral potential segment in the entire interview for the precious metals community, because Rule is not dismissing silver. He is precisely explaining why the squeeze mechanism as imagined by retail participants structurally cannot work. The exchanges are not neutral referees. COMEX and the LME are owned by their largest members, the same institutions that hold the short positions. When those members face forced delivery, the exchange itself has the legal authority and the business incentive to declare force majeure, halt trading, and cash settle at a price they effectively determine. This happened in nickel in March 2022. The LME halted trading when Tsingshan faced a catastrophic short squeeze, canceled all executed trades in the Asian session retroactively, and suspended the contract, allowing the shorts to unwind without delivering physical metal. The silver squeeze community is betting on a mechanism controlled by the counterparty. Rule is not saying silver does not go up. He says it will not go up because retail traders force a physical delivery crisis. It goes up because fundamental monetary demand, industrial demand, and supply scarcity eventually overwhelm paper pricing, which is a completely different mechanism.
So we're going to see a couple more halts here, technical glitches, I'm sorry?
That's insane. Yes, probably.
Yeah.
I mean, understand the beast for what it is.
Yeah. It's interesting. I mean, your friend Eric Sprott was also bringing up on Friday how the market will change come April 1st because of India's new law from the SCBI. They have $365 billion, 30% of it to supply gold and silver spot prices. I mean, is that a new bid?
I've watched India for a long time.
Yeah.
They don't have anything like permanent policy. I remember some years ago when the Indian government put a big excise tax on gold. I had some friends who were Gujaratis, and they were, well, I would call them traders. The Indian government would call them smugglers. And I asked them about that circumstance, and they said, well, we hope the excise tax continues. And I said, well, why is that? They said, well, it costs us 2.5% in bribes to land the gold in India, and there's a 15% excise tax. And they built us in 12.5% margin.
Just small. Just small. I mean, these are huge swings. These are huge.
On top of their normal margin. It's
What have you learned? I mean, you've learned a lot, but coming through this industry now with Bullion Bank, for instance, launching the bank, I mean, it being actively going, I mean, exciting times, no?
These are exciting times. And, my suspicion is, we've talked about this before, given the likelihood of the deterioration in purchasing power for the US dollar, and by the way, the Canadian dollar for 10 years, I think if you look over the next decade, the gold price, at least the nominal gold price, will do well. I don't think that the pace of increase will rival the pace that we enjoyed in 2025. So the listeners that you have who believe that the gold price will double in the next 12 months, will be needlessly disappointed. Let's say it went up 10% or 15%.
Yeah.
Let's say, too, just for fun, believing like Eric Sprott, that the gold and silver companies discount fairly substantially the current price of gold and silver. If gold and silver just went sideways, the stocks need to go up to catch up. So there's lots of room left in this market, assuming that your listeners don't have overinflated expectation. I think that's the important thing. I think don't lose your head about where we are. There's great advantage coming. If you keep your head and you play the game just with the facts at hand, as opposed to exaggerating that in your own mind, you're going to do very, very, very well. If you make mistakes in a market like this, it's tragic. There will be a lot of people who conspire to lose money in this market.
Rules forward calibration is the most important segment for investors entering now. He is emphatically bullish over a decade. But the 2025 pace of appreciation, gold gaining roughly $2,000 in a single year, was exceptional, and extrapolating it into 2026 and 2027 will create the disappointed sellers who exit at exactly the wrong time. The practical reframe: that equities still discount the current spot price and must go up to close that gap even in a flat metals environment, is the entry point for anyone who feels they missed the physical metal move. The conspiring to lose money phrase is Rule's 50-year observation of investor self-destruction. Buying momentum at tops, adding leverage at the wrong time, owning the wrong companies, and panicking on the first 20% correction. In a genuine secular bull market, the primary enemy is not the market, it is the investor.
How many, you talked to, you got the bank, right? Tell me a little bit more about the customers coming to you right now.
Well, the customers right now are superb customers. We, for your listeners who don't know, our bank, Battle Bank, among its premium product lines we will allow you to access the credit that you have in your stack. If you've been storing gold and silver, you need working capital for your business, you need money for a down payment on a triplex or something like that, we will loan you money against your gold and silver. For three reasons really. Gold and silver, first of all, are very good collateral. If you don't pay me, I can liquidate you in 10 seconds, 24/7. Right? The second thing is, for whatever reason, they've been out of favor for so long that there's no competition in that space.
Just central banks.
Which is wonderful. Yeah. The third thing is, in my experience, the people who buy gold and silver, in addition to the fact that I know them, I've been talking to them for 50 years, are pretty prudent. They're the kind of people you would want to lend money to. So the loans we've made so far are, as an example, a home builder who owns $10 million worth of bullion and occasionally needs $2.5 million to
capital
for a subdivision. He finances out with a construction loan, but he or she has a need for 9 months for $2.5 or $3 million. Perfect. Oh, yeah. Perfect borrower. It's been a dream product so far.
You're back on that side. It's just interesting times, right? Yeah. Talk to me about the conference. Obviously, one of our favorite conferences that we go to here at Kitco News, because it's so easy to find the guests that we actually want to talk to, is your conference down at Boca Raton. You sold it out very quick in terms of the people that are actually coming to exhibit. A lot of excitement there, but you can still go online.
Yes. What you say is true. For the first time in 20 years, we've sold out the live portion of the conference, which is wonderful. We have basically infinite capacity online. So people who are interested can go to rulesymposium.com or better yet, link through the Kitco page and see us there. That conference, unlike any other conference I know, comes with an absolute ironclad money-back guarantee. If you attend the conference and you don't think you got your money's worth, we'll give you your money back. Now, the other thing that people need to know is, although the conference lasts only 4 days, it's 46 hours over 4 days. It's extremely intense. What that means is that you will likely need to avail yourself of the recordings after the conference to refresh your memory on things that might have slipped your mind. And then the last thing is that I personally interview every speaker and every exhibitor at the conference before the conference, so that you arrive at the conference knowing what you want to hear, so you can allocate your time more efficiently. If you go to Rule Investment Media YouTube channel, what you will see before the conference, whether frankly you attend or not, are all those interviews. They're all absolutely free. But it's important to note, to get your money out of the conference, A, watch the pre-conference interviews, B, watch the conference, C, play the tapes to hear what you missed.
Yeah, a lot of content there. I mean, you've been building, it almost feels like, this is going to be a legacy.
Well, that is what it's going to be.
Yeah.
At some point in time, I shed my mortal coil, and it is precisely a legacy. That's what it's all about. Hopefully, when that time comes, the enterprise, which is the publishing business and the conference business, the people who now are employees, will continue that conference on. It's precisely a legacy.
And to your point, I mean, the people that are at the conference, you vetted them, you've looked at them, you're in the deals. For a retail investor kind of looking right now, I mean, say they're watching their 401k bleed a little bit today. I mean, what are those 3 metrics that we need to see from a company and know that it's going to survive?
Value, first of all. Money ultimately is made in the delta between the price you pay and the value you receive. Yeah. The value might be anticipatory. In other words, it might be that the value isn't present now, but you can see over 3 years or 5 years how the management team could add a lot of value. The delta between the price and value is where money is made. The second thing among the juniors is human capital. Right. It's all about the jockey. Yeah. And the jockey needn't merely be a success. The jockey needs to be a success at the task at hand. If the jockey was a success operating a gold mine in French-speaking Quebec, and the task at hand is exploring as opposed to operating in tertiary volcanics for copper gold deposits in Spanish-speaking Chile, the success isn't necessarily appropriate to the task at hand. So it's important that the speculator understand that the management team has to be successful, but that success has to be appropriate.
Yeah.
The third thing is that the management team has to have a plan to add value that you understand. I ask every exhibitor here that I talk to, and there'll be about 100 this year, tell me the most important unanswered question in front of you. Not what your ultimate goal is, but tell me the interim step that increases the market's understanding of the value of your project. 80% of the time I ask that question, the management team can't answer it, which is to say they don't have a plan. Now think about that. How are you going to get somewhere without a plan?
That's an interesting one. How many people have you asked? I mean, you said you're talking to 100.
I've been doing this for 40 years.
Yeah, so a lot of...
Literally 80% of the time I ask the question, the management team says, well, we've never thought of it that way. What that means is that to them, the most important unanswered question is, will I draw a paycheck in 2027? I don't mean to be harsh, but I don't care.
Yeah.
Rule's 3-metric framework is the most actionable investor education in this interview. And the 80% statistic is the most alarming number he delivers. He is not saying 80% of junior mining companies are bad investments. He is saying 80% of management teams, the actual people responsible for allocating your capital, cannot articulate the next concrete value-adding step for their own project when directly asked. This is not a technicality. If management cannot tell you what the most important unanswered question is for their project, they have no coherent plan to answer it. They are explorers with a drill rig and no map. The jockey nuance is equally important and equally ignored. The mining industry is filled with people who made real money in one specific context, operating a producing mine in a stable jurisdiction, being handed exploration capital for a completely different task in a different environment and language. Success does not transfer. The investor's job is not to ask, has this person made money in mining? But has this person succeeded at this specific task in this specific context before?
Right. Yeah. And I mean, if they got stake in the game, they shouldn't either. Okay, quickly, just before I let you go, we're coming up on 30 minutes. I just want to know your take on uranium and obviously copper, because we're hearing a lot of M&A discussion this morning on that copper deal.
Yep. Both of them over the 5 or 10 year time frame are inevitabilities. The uranium market in particular, because the structure of the market is going from spot to contract, there are profound differences. We can talk about that in a subsequent interview. That's a 10 or 15 minute discussion. It's profound. It's really, really, really important. But people need to know that. They need to see that the term market, which is opaque, is $8 ahead of the spot market. People are willing to pay a premium to have security of supply over time, which is important. People need to understand that.
It's a big value.
Big, big, big value. Now, remember, there's probably 150 so-called uranium companies in the world. There are probably 11 that are worth a bid, so you got to throw the rest of the way. The copper space, similarly, I was at Metals Week in London, and I heard a really stunning statistic, which is that the biggest copper producers in the world need to invest $250 billion constant 2025 dollars to maintain current production. Now, current production is at a deficit, and demand is growing at 2% compounded. And the input in terms of front-end capital costs are escalating at about 8% compounded. So what is today a $10 billion build, next year will be an $11 billion build. The year after that will be a 12.5 build. You follow what I'm saying?
Yeah.
A lot of money needs to be spent in the copper business to maintain the current levels of production, which are by themselves insufficient for 10 years from now. Now, there's going to be a lot of copper pretenders. There's going to be a lot of amalgamations of butchers and bakers and candlestick makers. And their slide deck is going to be all about the copper rather than the fact that their company doesn't have any copper. So
maybe that's why Friedland's so excited right now.
There's nobody like Robert.
Yeah.
There's nobody like Robert.
Yeah, he's been planning for this for a moment, I think.
Robert, I mean, first of all, I joke that whatever Robert happens to have, the world is desperately short of.
Yeah.
But part of that is because he's been spending $10 or $12 million a month on exploration for many, many, many years.
The copper supply math is the single most structurally compelling number in the interview. $250 billion in constant 2025 dollars just to maintain, not grow, production levels that are already insufficient. With demand growing 2% compounded and build costs escalating 8% compounded, the gap between what needs to be spent and what is actually being spent widens every single year. The arithmetic is inexorable. Today's $10 billion mine build costs $11 billion next year. The copper that cannot be produced today because the investment was not made 5 years ago cannot be pulled forward. No amount of Federal Reserve printing creates a copper mine. This is a physical constraint, not a financial one. The uranium term market observation, utilities paying $8 above spot to lock in long-term supply contracts, is the price signal that utilities no longer trust spot market availability. They are paying a certainty premium. That is the early innings signal of a structural shortage being priced in. Rule's caveat on uranium, 11 worth a bid out of 150, is the same discipline he applied to silver. The underlying commodity is an inevitability, but most companies in the sector will destroy capital regardless.